All right, let's talk about your financial life journey. Think of it like a road trip. At every single stage, you're going to need different tools, right? Today, we're going to unpack that. Everything from insurance to retirement plans and turn all that complicated financial stuff into a simple, clear map you can actually use. So let's just cut to the chase with the big question. Are you actually using the right financial tools for your stage in life? I mean, what you need in your 20s is totally different from what you need in your 50s, right? And using the wrong tool can seriously cost you. So that's what we're here to do, match the right tool to where you are right now. Okay, so here's the plan for our little journey. We're going to start with the basics, the benefits you get from your job. Then we'll get into protecting everything you build up. After that, we'll talk about those big financial crossroads we all face. And finally, we'll wrap it up with how to secure your retirement and legacy. So, I want you to think about your financial life like a big project. Maybe you're building a house. Maybe you're building a future for your family. Either way, you can't do it without the right toolkit, right? Every single thing we talk about today, it's just a specific tool for a specific job you'll face along the way. And for most of us, where do we get our first tools? Yep, at work. You land that first big job and suddenly they hand you this whole package of benefits. It's basically your starter toolkit. So let's open up that box and see what we've got. Okay, first up is usually group life insurance. It basically comes in two flavors. You've got contributory, where you and your boss both chip in for the cost. Then there's non-contributory, where your employer pays for the whole thing. And that's the one you really want to pay attention to. If you see that, it's a huge perk. It's designed to get good people to join the company, which means for you, it's pure value at zero cost. All right, next tool in the box, retirement plans. And there are really two main kinds to know about. On one side, you've got your qualified plans. Think 401ks. These are for pretty much everybody. They give you nice tax breaks, and your money is protected by federal law. But then you have non-qualified plans. These are a whole different animal. They're usually just for top executives. They let them save way, way more money. But here's the catch. That money isn't protected if the company goes belly up. So yeah, it's a high reward, but definitely a high risk kind of tool. But what happens to that life insurance when you leave your job? Do you just lose it? Well, that's where this super important thing called a conversion privilege comes in. Seriously, remember this one. It's your right to take that group plan and turn it into your own individual policy. And here's the kicker, without a medical exam. This is a huge, huge deal. It means you're guaranteed to stay insured, even if your health has changed. It's a lifesaver.
Okay, so you've been working for a while. You're moving along in life. Maybe you've got a family now, a house. Maybe you even started a business. The game starts to change, doesn't it? The focus isn't just on getting started anymore. Now it's all about protecting everything you've worked so hard for.
So the big question is, how much life insurance do you actually need? It's not just a random number you pull out of the air. It's a process called a needs analysis. It's actually pretty straightforward. First, you just look at what you have right now, your income, your debts, the whole picture. Then you figure out what your family would need in the future, college, mortgage payments, all that. And finally, you just do the math. You find the gap between what they'll need and what you've got. And boom, that gap, that's the amount of coverage you're looking for. Okay, let's switch gears and talk about business for a sec. Imagine your company has that one person, the one, the genius who makes everything work. What would happen if they were suddenly gone? It could sink the company, right? Well, that's exactly what key person insurance is for. The business itself buys an insurance policy on that crucial employee. If, God forbid, something happens, the business gets the money. It's not for the family. It's a survival tool for the company to give them the cash to find a replacement and stay afloat. And sticking with business, what about partners? This is where a buy-sell agreement is absolutely critical. Honestly, the best way to think about it is like a prenup for business partners. It's a legally binding contract that lays out exactly what happens if a partner dies or gets disabled or just decides to leave. And here's the smart part. They're often funded with life insurance policies on each partner. So if one partner passes away, the other partners instantly get the cash to buy that person's share from their family. It keeps the business running without any chaos. So, both of those things we just talked about, key person and buy-sell agreements, they're both what we call third-party ownership. It's a simple idea. The person or company owning the policy isn't the person who's actually insured. Now, this can be an incredible tool for financial security, for sure, but it can get complicated. We're talking potential tax headaches or the insured person losing control over their own policy. So, the big takeaway here is these setups absolutely need a good lawyer and financial advisor to look them over. no exceptions. You know, life is never just a straight road, is it? We all hit these crossroads, a big career change, a sudden financial pinch, or your family's needs just totally shifting. So this next part is all about the specialized tools that can help you handle those moments and make really smart moves when things get complicated. All right, let's paint a picture. Imagine you've got this big life insurance policy. You've been paying into it for years, maybe decades, but now maybe the kids are grown, the mortgage is paid off, or the premiums are just getting to be too much. Your first instinct might be to just let it go, right? Just stop paying. But hold on, you might have another, much better option. So you basically have two main choices here. Option one, you can surrender the policy. That just means you give it back to the insurance company and they give you its cash value, which frankly is usually not a whole lot of money. But then there's option two, a life settlement. This is where you actually sell your policy to a third-party investor. They give you a lump sum of cash and, this is the key part, it's more than the surrender value. Then they take over the premium payments and collect the benefit down the road. It's a way to get more value out of an asset you don't need anymore.
Okay, now for something you really, really want to avoid. It's called a modified endowment contract, or a MEC for short. Think of it like a penalty flag from the IRS. It happens when you overfund a life insurance policy. You basically put too much cash into it too fast. And when a policy gets flagged as a MEC, it loses its amazing tax advantages. Suddenly, any money you take out becomes taxable, and you could even get hit with a 10% penalty. It's a huge trap, and the way to avoid it is just to make sure you're funding your policy correctly from day one.
All right, we've come a long way, and that brings us to the final leg of this journey. This is the part where we focus on making sure all that wealth you've built up over the years doesn't just take care of you in retirement, but that it also creates the kind of legacy you want to leave behind. And for most people in the US, the foundation of that retirement plan is Social Security. It's easy to think of it as just a check you get when you're older, but it's so much more. It's really a massive safety net. It provides income if you become disabled and can't work, and it provides for your family if you pass away. It's all based on your work history, and it's an absolutely crucial piece of the puzzle you have to factor into your retirement plan. So let's end by circling all the way back to life insurance and reminding ourselves of its biggest superpower, the tax treatment. It's pretty simple. The money you pay in, your premiums, you can't deduct that from your taxes. But the most important part, the death benefit, the big check your family receives, is almost always completely income tax-free. That right there is why it's such a cornerstone of estate planning. Oh, and any dividends you might get? Usually not taxed either, because the IRS just sees it as them giving you some of your own money back. So that's our journey. We've gone all the way from your very first 401k to some pretty advanced tools for protecting your business and your legacy. But, you know, this whole thing is your journey. Your financial story is still being written. So I guess the only question left is, now that you've seen the tools in the toolkit, what's the next chapter for you going to look like?